Hey, Melissa, we've got three things we're going to focus on. Let's start first off with the Q2 results, which a lot of people will look at and they'll say, well, we know it was a disaster. It was a disaster for all the airlines, but we're going to give you the numbers nonetheless. It was a loss of $1.6 billion. They reported a profit of $1 billion in the second quarter of last year. That comes out to a loss of $9.31 a share, worse than what the street was expected, but the estimates were all over the place. And revenue coming in a little better than expected at $1.47 billion. The estimate was just over $1.3 billion. The first key metric of the two we're going to focus on, where do things stand in terms of daily cash burn? In the second quarter, United's daily cash burn was $40 million a day. That is on the low end of the guidance that the airline provided, which was between $40 and $45 million a day. For the third quarter, and this is new guidance, it's going to be an average of $25 million a day. That is the company's guidance at this point. Previously, it was saying it expected daily cash burn at $30 million. So that's an improvement of about $5 million a day in terms of daily cash burn. And then the other key metric we're focusing on, liquidity. Remember, cash is king, and it's all about having enough to ride out not only the third and the fourth quarters, but also the first quarter, which is going to be a brutal one for the airlines. Currently, they are sitting on $15.8 billion. At the end of the third quarter, United expects to have over $18 billion. And by the way, that includes a loan from the Treasury Department for $4.5 billion that United has not tapped, but likely will tap. All the airlines have this secondary loan from the Treasury Department that's been approved, yet many of them have not yet tapped it. They have until the end of September to make that decision. Don't forget, tomorrow morning, you do not want to miss this exclusive. We'll be talking with United CEO Scott Kirby exclusively on Squawk Box. And look, this all comes down to his view of where the market is right now. And you've heard, Melissa, Jim Cramer has talked about this. Others have talked about this. Are the airlines strictly a vaccination play right now? In other words, people aren't going to fly in big numbers, and traffic's not going to come back until we get some really positive news on a vaccine. And not more than what we've seen so far. In other words, people can say, aha, I see it coming. I know that it's coming. Therefore, I'm going to get back on boards. We'll talk to Scott Kirby about that tomorrow morning on Squawk.
We look forward to that, Phil. As for the $25 million a day cash burn number for the third quarter, what's your take on why it's lower than expected? Is it probably more headcount reduction?
Well, a couple of things. Headcount reduction, which kicks in, that really doesn't kick in until the end of the third quarter. So it's less about headcount reduction. Really, it's not about that. It's more about the fact that they've done a great job in terms of limiting capacity. When you look at their load factors and where they are in terms of how many seats they put in the air, they have been much more aggressive than their competitors about saying, we're just not going to fly. We're not going to put planes out there and try to flood the market with seats and hope that people come back. They have been very judicious, and that's showing up in the cash burn coming down as aggressively as it has been.
Very different from American Airlines' attitude. Phil, thank you. Phil LeBeau with UAL's report. So lower cash burn in the third quarter, higher cash position. That means a longer lifeline, Tim, for UAL.
Yeah, do some quick math. Basically 4 times 25, you get to 100 times 10. So $1 billion they burn in every 40 days. They're going to have $18 billion by the end of the third quarter. So we know they've got about a year and a half is just what I did. Maybe I'm wrong, right or wrong. But I think the story that Phil's talking about is matching essentially demand, supply, demand. So load factor for August will be at 35. It was 40 in July. The concerning thing is the good thing here, right? So their cash burn is coming down because they're matching demand. But 6 weeks ago, we were talking about, if you look at bookings out of Newark in the end of June, they were down 65%. As we go into August, they're going to be down 85%. So we had thought as we got through the summer, we were actually going to see more of that capacity coming back online. In fact, they're going the other way. That's good news for shareholders, I believe, but ultimately normalized earnings for airlines, we really have no idea.
Yeah. Karen's on the phone now. Karen, your take on United Airlines, especially as New York is adding more states to the travel ban list or the list from which visitors must quarantine 2 weeks when they arrive in New York. Karen? Okay. We'll try and get Karen on the phone. In the meantime, Jeff Mills, I'll go to you because as Tim had pointed out, just a couple weeks ago, we were talking about UAL having all sorts of cancellations because of its presence in the New York, New Jersey area. And here we are. More and more states are being added to that long list of quarantine states. More trouble for the airline.
Yeah, and I've been pretty vocal about my trepidation about the industry overall, but I do think looking at UAL specifically, it's a stock that's down 62%, and it's interestingly showing some pretty good support at the upward sloping 50-day moving average. So I do believe that it's a reopening play. I do believe that it's a vaccine play. So if you're an investor that believes those headlines are going to be positive, I think you could play it here for a trade just from a technical perspective, but I would keep a short leash on it. I go back to the specifics of the company and I think about international demand and international revenue exposure as an example. A company like United is pushing upwards of 40% of their revenue exposure linked to international travel demand, where some of the other larger carriers, Delta, American, more in the mid-20s. So I think that's particularly problematic for them. And then also, I think about their pricing and the ability to price for profitability. Go back to the financial crisis. Think about how many years it took for airlines to get back to pricing that led to profitability. So when you think about the cash burn and trying to triangulate that to profitability, I think we have to keep that in mind, virus or no virus. How long does it take to work off some of the lingering effects of the recession? And then you tack on top of that some of the questions, I think, from business travel demand, and that being more of a secular shift. For me, I'm still very cautious.
I mean, some might call the airlines zombie companies at this point because they're not making money, but yet they have huge cash positions on their balance sheets that will keep them afloat, Chris.
I think Jeff's got this right. Is it tradable in the context of the next number of weeks? It may be. That 30 level, I think, is big support. But is it investable in the context of, is this stock going to be a leader over the next number of years? And that's where I'm a skeptic. And looking at the airlines today reminds me so much of how the banks traded off the 2009 lows. Remember, the bank stocks doubled and tripled the first couple months off the March 09 lows, and then they were stuck there year after year after year. When you're at the scene of the accident, like the airlines are right now, the likelihood historically that you return as a leader in the next cycle is pretty low. So maybe they're tradable, but are they a secular leader on the other side of this? Probably not.